So there are businesses that sell for a 3x EBITDA, and then there's others that sell for a 12x. Now, the biggest factor here are the financials and the actual industry of the company. And so, what many people don't actually realize is that there are certain levers that you can pull to actually significantly increase it. The obvious question is, why should you be listening to a guy in the middle of the snow in a camping chair? Well, to answer this quite simple, my name is Tyler Bavacqua. I'm the managing partner at E76, and so we are an operations firm working primarily with private equity and venture to optimize their portfolio of companies. And so therefore, I have been involved in a few M&A deals myself, and I've seen firsthand what actually moves the needle. So let's get into it. So we are going to be mathematically proving future value through structural financial levers. And so the thesis that I had when making this is we want to maximize valuation. And to do that, we must move beyond standard accounting and actually move into finance modeling and narrative arbitrage. And so the key objective is to actually construct models that mathematically demonstrate that the business is worth significantly more in the future under a strategic buyer than it was in the past. And so these are the 5 levers that we're going to talk about to actually drive your valuation. First one being the EBITDA bridge. Now, the EBITDA bridge is your most critical valuation tool because it bridges the gap between a reported EBITDA, on what the tax return says, and the actual pro forma EBITDA, which is what the business is actually worth to a buyer. Now, the formula that we use here is reported EBITDA plus add backs plus run rate adjustment plus synergies equals your pro forma EBITDA. Now, the reported EBITDA is quite simple. This is your baseline on the P&L. It's always going to be artificially lower because most business owners are always trying to minimize on their taxes they have to pay every single year. Now, add backs are expenses that a new owner would not incur. Things like a leased car, a trip to Cabo, a country club membership, things like that. And also one-time fees like legal, recruiting, and maybe website redesign. And then also above market salary. Say you make $500,000 every single year, but a replacement CEO would only cost $250,000. You add back that $250,000 difference. Now, third part is the run rate adjustments. Now, say we, signed a huge contract in October. The 12 months trailing does not reflect the current earning power because it's annualized in recent months. And the last part is synergies. So these are cost eliminations for strategic buyers. Say you have a CFO and your buyer also has a CFO. It's going to just be consolidated into one. Same goes with software. And so there's often 3 tiers that when we look at kind of, in terms of getting the most EBITDA essentially. And buyers will usually accept 90 to 95 of tier 1, 60 to 70% of tier 2, and around 20 to 30% of tier 3. And so the tier 1 is the least resistant. This is owner comp above market, like we mentioned earlier, personal vehicle and travel, family on payroll, and then one-time fees. The second tier, being moderate, is above market rent, charitable donations, and then pre-revenue product R&D. And the last one is the highest resistance, being tier 3, which is normalized marketing spend, deferred maintenance, and project savings. And so what we need to always do is we always want to document everything. Every dollar that we spend and that goes out, we always need a paper trail. You want to have an invoice with a 2 to 3 sentence memo explaining what this is for, and then the market comparison. Like, we spent 20K on rent, our competitors spend 40K on rent. Something like that, but obviously more in depth. And so this waterfall chart allows you to understand how to go from $2 million to $3.7 million. With the add backs, with the run rates, and with the synergies, we can add an extra $1.7 million to the pro forma. And oftentimes buyers will scrutinize add backs, and of course because they don't want to pay more. But what we need to do is always document every add back with precision. Like I said, put this in a binder, have 2 to 3 sentence memos explaining why this is, we're paying for this and why they're non-recurring. And then of course the market comparison for compensation add backs. And so I already mentioned an example. I'm not going to go into that one, but I'm going to talk about execution, right? So when it comes in time to present this to the buyer, we always want to lead with that reported EBITDA from audited financials, which build credibility. And then after that, we present the tier 1, we get them to 9 and say, okay, this sounds good, this sounds good. Then we quantify with precision. So we're not saying, we're not rounding up or providing the exact number down to the actual cents of it. And then we say, hey, go look at exhibit C for this, further information. And so once we do that, then we preempt objections for tier 2 items, which acknowledge buyer might discount, maybe not. And so the goal here is to actually anchor at pro forma and then negotiate down. So we want to say, hey, we want 3.7, and then you kind of work your way down. Sometimes, if you go to 2 million, it's kind of hard to go up from 2 to 3.7 million. And so what you need to do for this is to stop personal expenses 2 years before the sale. We want clean financials, and it's always worth more than tax savings. So we want to actually keep a deal file, like I just mentioned, every time you spend on something, so the buyer won't need to. Things like maybe one-time patent filing, reconstruction consultant, right? Save an invoice and note it. And so when due diligence actually starts and the process begins, hand them the pre-packaged add-back schedule, and so you can actually pre-identify strategic synergies. If the buyer has a massive sales force, for example, you can calculate your revenue plugged into their distribution, right? And of course, you can commission your own quality of earnings report 6 months pre-sale to actually identify and fix add-back credibility issues before buyers find them. Now, the second point I want to touch on is the net revenue retention, right? This shifts the narrative from sales velocity of, how fast we sell, to product stickiness, which is how much value do we actually keep on a buyer and a customer, right? Strategic buyers will often pay 2 to 3x higher multiples for revenues that compound automatically. Here's the quick formula. You can save it. It's the general formula that we like to use. And so the starting revenue, I'll just explain each point. The starting revenue is, of course, the beginning of the period. The upgrades are added revenue from same customers via upsells. Churn is lost revenue. And our goal is to have this be over 100%. And for example, if sales went on vacation for a year and they just didn't happen, the revenue would still grow. And you can look at kind of this general, chart here where you can see in year 1, year 2, year 3, it just continues to expand. And so the explanation here and like the actual execution is we want to rename our customer support to customer success. And the reason why is because we want to compensate on net retention, not things like ticket resolution. So if we do that, we can then go ahead and build a 3 to 5% annual price escalators into contract, and this will always combat churn. Now, the next point I want to talk about is the actual operating leverage. Now, for every dollar of additional revenue that we make, the question we always want to ask is how much drops the actual bottom line? Low leverage, for example, consulting, requires more people for more money. High leverage, something like software, keeps actual costs flat while revenue continues to explode. And so the contribution margin is looking at more so profit per unit. So let's say software is $100 and the server costs $5. Then the margin there is 95%. Consulting, for example, $100 and a consultant costs $60, it's 40%. Right? We always want to look at the DOR ratio, which means that, we want to have for example, 3x in this case might mean a 10% increase to leads, which has a 30% profit increase. Now, this nonlinear growth is what buyers pay for. And so the visualization here, we have 1, which is a standard business where revenue grows 20% and the profit grows 20%. Then we have an actual linear high leverage company, 3 to 1, where revenue grows 20% and the profit grows 60%, which is exponential. And so your P&L structure should always be something like this. It should be clearly distinguished from your cost of goods from the actual OPEX, the fixed costs. And if you lump them together, you hide your leverage and the buyers assume you have none. If you can, always automate delivery as much as humanly possible, because humans are variable costs, but software isn't, right? If you have automations, the costs are often the same. And the better thing to look at it is keep the humans, have the automations do more work, but the humans actually are able to do higher impact, more brain power work that can lead to the company growing higher. That's how you have a very lean team, doing 40 million a month or something like that. Now, the fourth part is working capital peg. Now, working capital is cash stuck in the business. Things like inventory plus AR minus AP in this instance. So in a deal, there is this target working capital peg, which the focus is to deliver more than the target, and then you get paid extra dollar for dollar. And so if you deliver less, your purchase price reduced dollar for dollar. And you can look at this formula. And a very big issue is the buyer might set a trap where he says, hey, we're going to set this peg of a trailing 12-month average. And so if your business is becoming more efficient, which, collecting faster, holding less inventory, whatever, But also, the 12-month average might be too high, which reflects your old insufficient self. And so we always want to do is use regression analysis to prove that the trend is downward. And so we always want to argue that the peg in this instance should be 3 months and not 12 months. And the last part is like the white space metric. Now, this is uncaptured revenue because the buyer will ask you and say, hey, I buy this, but how do I grow without new customers? And we want to show the low hanging fruit. For example, we sell product B to customers who only bought product A. So a visualization you can use is this map here where it shows, we have product A and then we have product B and then we have product C. And then we can see, for example, if a customer bought product A and product B, we can upsell them onto product C. And so, the gross potential revenue and the opportunity value is 125K. And the last thing I want to mention here, do not blast new product to 100% of the actual baseline sale. We want to sell to 10% to actually prove the attachment rate and that people will buy it. And then after that, we can have 500 customers do it, and then we can launch the product. We don't want to sell this new product and this new upsell to everyone out the gate. We want to just test it in a small controlled environment, figure out what works, what doesn't, and then blast it out to the world. And so these are arguably the biggest financial levers that you can pull when you're wanting to sell your company and have a higher EBITDA. Now, for those of you that are doing anywhere from a few $100K to a few $1 million in annual revenue, you can check out my passion project. Link is in the description. I hope you enjoyed this video. Let me know your thoughts. Let me know what you want to see in the future. Ciao.